Sam, a lot of discussion about the 100th trading day of the year today and what happens when you hit that day and you're up 10% year to date. It's rarely a negative full year. It has happened. I just wonder what history is telling you about this moment.
Sure, Carl. Well, there have been a lot of things that have been favorable so far this year. January 19th, we recovered everything we lost in the 2022 bear market. On March 28th, we hit our 22nd all-time high. Now we're at 24. The first quarter was the 11th best since World War II. And we also just recovered on April 19th, the most recent 5.5% pullback. History does say that we probably are due for another decline of 5% or more. But if that low comes in before July 31st, every time that has happened since World War II, the market was up for the full year.
Do you think the risk of a melt-up is more acute now than it was, say, 6 months ago?
Well, I think that it's being driven certainly by companies like NVIDIA, semiconductors on the industry level. And yeah, I think investors continue to focus on the large caps, mainly because the small caps, while they look very attractive from a fundamental perspective, really are not being given the relative benefit of outperforming the large caps, mainly because the Fed remains slower to lower interest rates. And there's still that possibility that they will cut only once or no time this year.
So, Dean, in light of that, the fact that we got these hotter than expected PMI readings this morning, you've seen yields move higher in response to that. That comes after Fed minutes yesterday that we knew coming into the release were going to be a little more hawkishly tilted, but nonetheless sent the market lower. How to think about this economy, how to think about where the Fed goes from here, if the Fed goes from here this year?
Yeah, I think the way to think about it is growth looks fine at this point. Growth is going to be somewhere in the 2.5% range, we think. Consumer spending is on a good trajectory. So the Fed has the luxury of waiting. So they're going to wait until the core inflation numbers look better than they did in the first quarter. So if we get to see some improvement over the next several months in the core inflation numbers, we think the Fed may cut as soon as September. But if the inflation numbers stay relatively high, then the Fed will stay on hold. So we think those are the two likely options at this point.
So when does good news become good news and bad news become bad news? Because it does seem like the inverse is still how we're trading here in the markets, Dean.
Yeah, I think that the growth numbers should be taken relatively positively by markets at this point. As long as the economy is not overheating, which is what the data have shown. We don't look like we're overheating at this point and growing too much. And as long as that's the case, as long as the growth numbers stay okay, then the focus really shifts to the inflation numbers. And if the inflation numbers improve at this point, I think that's the best possible scenario for markets.
Sam, I'll give you a chance to weigh in on that. I mean, the minutes were interesting yesterday, particularly the bit about, quote, various participants being open to tightening if inflation doesn't cooperate. A lot of discussion of what various means.
Well, that's true. I mean, I would have to say I agree with Dean on most of his points, that our belief is the economy is growing, that we are likely to be seeing the first cut in September. But I would agree that if there is a wild card, it means that the Fed probably will take its time, reminding us once again that they are data dependent. AI is driving NVIDIA and tech, but EI, earnings and inflation, I think will be driving the market forward. And if inflation remains fairly sticky, then that could cause the market to spin its wheels.
Sam, volatility is very, very dormant in this market. Does that surprise you, given the fact that you do have murkiness in the data? Yes, I realize it's still strong, it's still resilient, but it's also keeping the Fed sitting on its hands right now. And given the fact that we are in an election year.
Well, election years actually do a little bit better in the Memorial Day through Labor Day period. Instead of being up only 1.6% since World War II, they are up 3.7% going back to World War II in the election year. In addition, what we find is that the frequency of advance goes from a coin toss up to almost 80%. So I would tend to say that price appreciation is likely to continue an upward trajectory. But I agree there are reasons why I think volatility could be picking up as well.
Hey, finally, Dean, people were looking at these PMIs this morning and paying a lot of attention to the employment component, which was down for a second successive month. It doesn't have the best track record on predicting NFP, but are you looking for softer jobs numbers in the months to come?
I think the labor market should continue to moderate somewhat, but I think all the signs say that job growth will remain healthy. Jobless claims remain very low. Corporate profit margins, as measured by corporate profits as a share of value added, is close to the highest level since the 1960s. And that's just not the kind of environment where corporations are going to start laying off people in large numbers. So we think job growth will remain healthy in the months ahead.